So last class we have done up to question number 103. Let us go to question number 104. The following supplemental products simultaneously through a refining process is given. Costing 93,000 is given to us. Okay. The joint products A and B have final selling price of 4 and 10 கொடுத்திருக்கான் 4 and 10 கொடுத்திருக்கான். Additional processing cost is what? 2 per pound for each product incurred after the split up point. Byproduct is sold at the split up point at what? 3 per pound கொடுத்திருக்கான். 3 per pound is given to us. Okay. The byproduct joint cost to be allocated using net realizable method is simple question. What is the byproduct output? 1000 into what is the NRV? 3. Byproducts are valued at which one? Byproducts are valued at NRV. Byproducts are valued at NRV. So, what is the value? 3000. Cost to be allocated to alpha cadre, not to the byproduct, not to the byproduct. So, what is the sale value? Or what is the joint cost? 93,000 less byproduct order sale value 3,000. Joint cost to be allocated. How much? 60,000. 90,000 minus 3,000. How much? 90,000 we have to allocate. On the basis of NRV. On the basis of which one? NRV. What is NRV of products? A 1000 in 10,000 into 10,000 into 4. 10,000 into 4, 40,000. Okay. B 5,000 into 10 minus, what is the additional cost? Oh, it's given. Additional cost 20,000. 5,000 into NRV direct போட்டுக்கலாம் 4 minus 2. 4 minus 2. 20,000. B into 10 minus 2. How much? 40,000. So the ratio is like 20,000 is to 40,000. So this comprises of 1/3. This comprises of what? 1/3. This comprises of which one? 2/3. So 1/3 of the cost will be allocated to all. So joint cost 90,000. In that, how much will be allocated? 1/3 of the value goes to alpha. The answer is 30,000. In the production process where joint products are produced, the primary factor that distinguishes joint products and byproduct is value. Value. What is the correct answer? Relative sales value. Byproducts will have a lower value. Joint products will have a higher value. Manufacturing company properly classifies account of one product as byproduct rather than main product because no sales value or low sales value. Low sales value compared to the main products. Low sales value compared to the main products. Joint cost 1,86,000. Alpha and beta have a selling price of 8 and 10 கொடுத்திருக்காங்க. Okay. Omega byproduct can be sold at 6 கொடுத்திருக்காங்க. Okay. So simple. What is the joint cost? Less byproduct value. 6,000. 1,000 into 6. So what is the net cost to be allocated? 1,80,000 is a cost to be allocated based on sale value at split off. Based on the sale value at split off is given. What is the sale value of at split off? 10,000 into 10,000 into 8, how much? 80,000. B, 5,000 into 20. So it will be 5,000 into 20. How much? 10,000. 1 lakh. Now, total is 1,80,000. So, to be allocated is 1,80,000. To be allocated is 1,80,000. They ask you to find out the joint cost to be allocated for which one? Alpha. So, it will be 80,000 divided by 1,80,000. Joint cost to be allocated is 1,80,000. To be allocated in which ratio? 80 is to 1 lakh. So, it will be 180,000 for the first. 80,000 for the first one. Same data as given. Sale value at split off method. Same data. Same data. How much to be allocated? How much joint cost to be allocated to alpha? What is the selling price of alpha at split off point? What is selling price of alpha at split off point? 10,000 into 4. No, final selling price is final selling price is 4 and 10 is given. Each product after split off, byproduct can be sold at split off, assuming that a byproduct it incurs no additional processing cost for alpha betas. Okay, joint cost allocated using sale value at split off method. Is there a sale value given? No sale value is given. Any doubt in it? So sale value at split off 40,000, 50,000. So out of 90,000, okay, proportionately 90,000 is allocated. Next one is based on physical measure. So allocated to which one? Oh, based on caloric value. So it will be 10,000 is into 4,400. 10,000 is into 4,400. How much it will be? 10,000 into 4,400 will be like 44 lakhs. 44 lakhs. The other will be 5,000 into 11,200. 5,000 into 11,200. 56.
$56 million. Sir.
56 million approximately. So 44 is to 56 ratio. 44 is to 56 ratio. 90,000 allocated. So it will be like 44 by 100. 56 million divided by this proportion. When you allocate 90,000 into 56 by 100. What is the answer? What is the answer?
50,400.
50,400. 44 is to 56. That is a caloric value. In that ratio, we allocate the joint cost. For B, it is 90,000 into 56 by 100. Based on weight for alpha. So 90,000 we know only joint cost to be allocated. For alpha it will be 10,000 divided by 15,000.
60,000, sir.
Answer is 60,000. Same question. Using NRV method. Betters using NRV method. Already we have done this for alpha. For alpha, we have done this already. Using NRV method already we have done this. For alpha it is 1/3, for beta it is what? 2/3, NRV. Selling price minus separate expenses, NRV. 20,000, 40,000 already we have done in the earlier question for alpha. Now they ask for beta. Beta 2/3 of the value, right? 40,000 by 60,000 into 90,000. 40,000 divided by 60,000 into 90,000. Does not inventory more feed, okay. Does not inventory more feed. Now there is no inventory for more feed, which means what is the joint cost? 93,000 into what is the proportion of value? 2/3 for betters. How much?
62, sir.
They tell you, I mean, they are not doing any allocation of cost for the byproduct. They are not inventorying which one? Byproducts. 93 into 2/3, how much you get? 62,000.
Sir, Anna does not inventory and வித்துறாங்கன்னு sir அர்த்தம்.
Which means they don't keep it at all, they discard it not. Byproduct is not processed at all. It's a meaning.
Okay.
112. He is a byproduct. Let us see. What is the joint cost? 7,20,000 less byproduct. 7,500 into 30 minus 1 lakh.
225,000. 125, sir. Minus 100 lakh. Sorry, sir.
1,25,000. This will give us joint cost to be allocated. Much. This is a joint cost to be allocated based on NRV. Based on NRV, there are two products, R and S. What is the final sale value? Final sale value of R and S. Final sale value of R and S. 2,500 into 150, right? 2,000.
Yes, sir.
2,500 into 150.
375 minus
3,75,000. Yes. 5,000 into 115. Less cost. Less further process cost. What is the further process cost? 1,50,000, 1,50,000. This will give us NRV. In this ratio, we have to allocate the cost. 225 is to 425. So joint cost will be 5,95,000 into, for which one they ask for? R, right? So 2,25,000 divided by, what is the total of this? 6,50,000. What is the answer you get?
205.91.
R is not processed further. S and T must be processed, which means R is not processed. We have to take this sale value at the split up only. 100 will be 2,50,000. So no cost, no further processing is done. So 2,50,000 divided by 6,75,000. Given only S and T has to be further processed. 220,370. So R is not processed. Only S and T is processed. Done. Question number 113. Simple. The purpose of having a byproduct itself is to reduce your main cost of production. C. Two by four and 4/8. Okay. Sawdust as a byproduct. Sawdust can be sold for 2. Packing cost for 0.01 per pound. Sale commission is 10% of selling price. What is the cost assigned to two products? Based on board feet. So first we have to see the sale value of byproduct here. What is the sale value of byproduct?
1.7 into 1,000.
What is the joint cost? What is the joint cost? 50,000 less byproduct. Byproduct product. What is the sale value? 2,000 into 2. 2,000 into. So the packing cost?
0.1.
1,000 into 0.1. 200. Then there is some more cost.
Sales commission.
Commission.
0.2.
10% of selling price now will be 200 minus 1. So to be allocated how much?
1,007.
1,000?
So மேலே 2,000 sir. 10% include 200.
Balance 48,300 to be allocated. To be allocated. The quantities பாருங்க 2 by 4 is 2 lakh. 4 by 8 is 1 lakh. If you look at the ratio, 2 is to 1 ratio. So it will be 48,300 into 48,300 into
Option D sir.
2 by 3. How much it will be?
32,200.
32,000. நீங்க 48,300 அப்படியே into 2/3 போடுங்க. 2/3 தான். Just 2/3. 32,200. The distinction between joint products and byproducts largely depend on market price.
Get value.
Before we go for this variable costing and absorption costing, let us discuss. Variable costing, we include only variable manufacturing cost. Okay. Absorption costing,
Cost of goods manufactured.
we include both variable manufacturing cost and fixed manufacturing overheads also we include. What is ignored in both? What is common to both?
Manufacturing cost.
Let it be variable or fixed. Let it be variable or what? Fixed administration or selling cost under both the method ignored. That is taken as periodic cost. What is the difference between variable costing and absorption costing? Only difference is which one? Fixed manufacturing overheads. Fixed manufacturing overheads. Simple. When production is equal to sales, otherwise opening stock is equal to closing stock. Beginning inventory is equal to closing inventory. No difference in profit. When sales is otherwise you can say production is more than sales, otherwise you can say closing stock, ending inventory is more than which one? Opening stock, beginning inventory. Then what will happen? Which method will have more profit? Which method will have more profit? Will show greater profit than which one? Marginal costing. Then if it is otherwise, production is less than sales, or you can say closing stock is less than opening stock, then which will have more profit? Absorption costing will have more profit than which costing? Marginal costing. The difference arises due to which one? Difference arises due to which one? Fixed manufacturing cost. Difference arises due to only fixed manufacturing cost. Sometimes they will give you profit in marginal costing, profit in absorption costing. Fixed overheads they will give you. Based on that you can do reverse working and find out. We'll see. Look at question number 116. Using absorption costing system, fixed manufacturing overheads are best described as absorption costing. It is included in which one? Absorption costing it is included in product cost. It is included in product cost. Sorry, yeah, it is indirect expenses. Fixed overheads are always called as what? Indirect expenses. Factory overheads. In which of the following situations ending inventory in the balance sheet computed under absorption costing is exactly equal to ending inventory in computed in variable cost? Illa. They are not asking profit, they are asking value of inventory. They don't ask you where the profit will be equal. They ask you ending inventory when, otherwise, whatever it is, when inventory value will be equal. Then there is no fixed overheads. When there is no fixed overheads at all, inventory value will be what? Same. They don't ask you profit difference. They ask you inventory value will be the same. Okay. There is no fixed cost at all. Only variable cost. Now, marginal costing as well as absorption costing will do what? Same period. Or same profit. Change in the period of operating income when using variable costing can be explained in Number of units into the contribution margin, sales minus variable cost. Otherwise, profit will change only because of which one? Variable cost. Marginal costing, profit will change only because of which one? Sales and variable cost. Sales and variable cost. Which is true when they are using variable costing. Which is true when they are using variable costing paper. Option? Profit fluctuates with which one? Sales. Because fixed costs are charged against revenue. So sales variable cost will change your profits. Absorption cost. Overheads are applied based on direct labor. Managers may do all the following except they can defer, such as to increase bonus. To increase bonus, they want to get more bonus. They can defer direct expenses. Produce the products requiring which one? Most direct labor. Yes. Increase the production schedules. Increase the production schedules independent of customer demands. They can do. Decrease the production of those items which require what? No. If they reduce the direct labor, they will get only what? Less bonus. Exception category. Which one they should not do? Read this and answer. It first cannot be an answer because factory insurance is a fixed cost. That cannot be a product cost. And the second option also, it cannot be. It cannot be the product cost. Factory insurance cannot be the product cost. Direct labor and finished goods shipping costs are which one? Period cost. It cannot be. Direct labor is part of product cost. Absorption costing, yeah, of course, the option are included. Factory insurance, direct labor are product cost. Okay, shipping, etc. are part of selling expenses. Direct labor is a product cost. Factory insurance and finished goods shipping are period cost. This is the correct one. Answer is D. 122, 123. Arguments for, arguments against. Against. Fixed factory overheads also are necessary to produce a product. You cannot manufacture only with which one? Variable cost. So if you use variable cost, you are telling only variable cost is there for manufacturing a product. No, without fixed cost, you cannot manufacture a product. Impact of fixed overheads in the calculation of per unit cost. Full costing, otherwise called as what? Absorption costing. Fixed overheads are there. Next, which is not true. The question is which is not true. Under absorption costing, operation costing, both sales volume, production volume. Okay. A manager who is evaluated based on variable costing operating profit will be tempted to increase the production at the end of the period to get more revenue. No, it's not possible. Only when there is a sales, you will have more revenue. Just because you increase the production, you will not get what? More profit. Because you produce, that will be like inventory. That will be like which one? Inventory. Only when there is a sales, then there will be more profit. Not a correct answer. Assuming absorption costing is used, which of the following including only product cost? Direct labor is a product cost. Direct material is a product cost. Sales material is not a product cost. So direct material எடுத்துக்கலாம், direct labor எடுத்துக்கலாம். Sales material, advertisement cost, etc. cannot be product cost. Indirect material, factory material can be production cost. Indirect labor can be a production cost. Sales commission cannot be the product cost. Factory utilities can be the product cost. Administrative supply cannot be the product cost. Labor cannot be the product. Administrative labor cannot be the product cost. Depreciation cannot be product cost. This also cannot be product. The tick பண்ணதால இது மேட்ச் ஆகுது பாருங்க. டிக் பண்ணதுல இது மூணுமே இருக்கு. இந்த ரெண்டு தான் இது இல்லை. இதெல்லாம் பர்ஃபெக்டா எல்லாமே மேட்ச் ஆகுது. Why not first one? Indirect labor you should have included, but not included. That cannot be the option. Answer is fourth problem. Dawn company has a significant fixed overhead cost. Significant fixed overhead cost for the company. Ending inventory is higher than which one? I mean, higher கொடுத்திருக்கான். If production is more than sales, absorption costing will show what? More profit than marginal costing. What is the correct answer? Yeah, read the question. Ending finished goods will be higher than absorption, more variable costing than absorption costing. See, ending inventory will never be more in marginal cost. Ending inventory will always, value of ending inventory will always be higher in which costing? Absorption costing. Close, they don't ask you about profit. They ask you to find out, compare and find out the value which one ending inventory. Always, inventory value will be higher in which costing? Absorption costing. Yeah. One of these. Always value of inventory. Look at this. The question is, in which of the following situations ending finished goods inventory will have a higher value in marginal costing than absorption costing? In marginal costing we include only one. For example, we are having 1,000 units of closing stock. The 1,000 units, did you apply variable costing or absorption costing? Definitely when you use absorption costing only, what value will be more. So none of the above situation. Okay. So variable costing as cost allocation cost in manufacturing, what to do? Read and answer. Non-variable indirect cost will not be treated as product cost. This also will not be treated as product cost. This is not as a period cost. So simple. Variable direct or indirect cost will be taken as which cost? Product cost. What do you mean by gross margin? No. Do they tell you? Do they tell you marginal costing and absorption costing? Sales minus cost of goods sold, we call it as what? Gross margin. So while working out cost of goods sold, we take both what? Direct as well as indirect costs. Direct as well as what? Indirect costs.
Gross margin naale absorption than is.
This includes both variable as well as what? Fixed
Like COGS.
overheads. Fixed overheads. Because the question is not specific about is it variable cost or absorption costing. If it is variable costing, then you would have done sales minus variable cost. What is the best reason for using which one? Variable cost paper.
Option A, sir.
Best reason for using variable cost. For example, we are having capacity to accommodate 30 students, but only 2 students are there. So which cost is more relevant? Variable cost is more relevant. Fixed cost is based on your capacity, not based on actual units produced, not based on which one? Actual units produced. So this is the best answer. Fixed costs are more closely related to which one? Capacity to produce rather than what? Actual number of units produced. They pay bonus to the manager based on operating income calculated under variable costing. Now, 2 months before the year end, the earnings have been depressed for some time. Which one of the following actions production manager implement? He decides to manufacture bonuses, certain bonuses this year. We are using which one? Variable costing. Implement with aid of the controller. This will affect only the future. Postpone 1.8 million of discretionary equipment maintenance until what? Next year.
C.
Advertising cost is not part of your variable costing. Set up more manufacturing cost to defer to the inventory. That's not possible. Probably this is possible. And that is part of your overheads. Repairs and maintenance are part of variable cost. Discretionary repairs and maintenance you can postpone so that variable cost will come down. Contribution will be more. You will get more bonus. You will get which one? More bonus. At your discretion, you can spend now. You can spend it later. You can spend it what? Later. So that if that is eliminated from product cost, you will have what? More variable. There is more contribution. Operating income under variable costing. Contribution margin minus
Variable selling and state.
why? Because sales minus variable cost, there we include only what? Manufacturing cost. What is not included? Fixed manufacturing cost, then variable and fixed selling and administration expense are not included. So if you want to have a net income, contribution minus what? All your fixed expenses and variable selling expenses. Answer is B. Fixed manufacturing orders. No. Yeah, that's correct. 132. Absorption costing and variance cost, variable costing and difference.
Option C.
Yes. If closing stock is more than opening stock, absorption costing will have a more income. If closing stock is more than opening stock, absorption costing will show a higher income. Just try 133, 134. I'll just come back in a minute. I'll talk to the other faculty in 3 minutes. Sure. Costs that are allocated to cost object in many ways, many reasons. Which one of the following is the purpose of cost allocation? What is the purpose of cost allocation? See, our cost allocation we do for indirect expenses, that we do it for measuring income, of course, finding out assets for which one? External reporting purpose. What is the advantage of using variable cost? Yes. Break-even point can be easily worked out. Break-even point can be easily worked out. That is 130. 135 per. While comparing absorption costing and variable costing, the difference in operating income can be obtained by difference between what?
Option D, sir.
Your number of units, difference in inventory. See, difference in inventory multiplied with fixed cost per unit. Okay, you want, okay, what is the difference in profit? Is equal to difference in inventory into fixed cost per unit. This will give us what is the difference in profit. Ending inventory and beginning inventory difference multiplied with what? Fixed cost per unit. We'll see. The management of a company computes net income using both absorption and variable costing approach. Product costing. Net income approach costing is greater than net income under absorption costing. Maybe variable cost is more. Net income under absorption costing approach is less. Otherwise, variable costing approach is more. Marginal costing approach is more, and your this one is less. Which situation? Sales is more than production. Production is less than sales. Otherwise, sales is more than production. Your marginal costing profit will be more than which profit? Absorption costing. 137. No, first one. No, it's not a correct one. It's an inventory cost. Second, absorption costing is not a period cost. That is also inventory. Absorption costing, variable manufacturing overheads is period cost. No. Absorption overheads, absorption costing, both variable and fixed is considered. Okay. Absorption costing include fixed overheads as usual. Period cost. That is a correct answer. Read 138.
Option B.
No, if you look at it, a review of firm's internal and external disclosures. We will not disclose this. We will not disclose this. This is the correct answer. Internal income figures will be closely changes with which one? Sales. But external income figures are influenced by what? Number of units as well as what? Stock. Proof concerning difference between variable costing and fixed costing. What is the correct answer?
Option 1.
Yeah, option C. The first one is correct. From second is also correct.
1 and 2, sir.
Production is greater than sales. Operating profit will have. Production is greater than sales now. Absorption costing will show what? More profit. This cannot be an answer. This also cannot be an answer. The answer is
1 and 2.
1 and 2. Director 1 and 2 hits the answer. If a manufacturing company uses variable costing system to cost inventories, which of the following costs are inventory costing?
C, sir.
Which one?
C.
Will you include variable administration selling overheads?
SC in a period, sir. BB.
Raw material, direct labor, variable manufacturing overheads cost only can be included. Under direct costing, fixed manufacturing overheads are classified as period cost.
So question simple agate sir.
Question. The company controller gathered the following data, assist the management, deciding which products should be selected for production. Fixed overheads include all your rent, utilities, machine depreciation, etc. is given to us. Selling and administrative expenses are not allocated to products are given to us. Okay. What is the selling price? 44. 49.95 is the selling price. Unit cost is how much? 44. Now here, the difference between 49.95 selling price and total cost is nothing but what? Gross profit. Why not it is contribution margin? Only variable cost can be included. They contribution margin கேட்டிருந்தானா selling price minus what? All your variable overheads. இது வரைக்கும் எடுத்திருந்தா that would have been selling price minus variable overheads would have been which one? Contribution margin. Okay, while working out gross profit, we take both variable as well as what? Fixed.
Fixed.
Which of the following is generally included in calculating operating income using absorption costing? Absorption costing. All.
Only.
Next. Which method of inventory costing treats direct manufacturing and manufacturing overheads, both variable and fixed, as inventoryable cost?
Absorption. C. Oh, no. Sales ಅಲ್ಲ, sorry, production.
We are doing which one? Absorption costing.
Absorption.
Absorption costing, when the profit will decrease or increase? Really? Think about it.
Decrease in sales. Profit year में.
Profit always decreases with decrease in sales? No. Increased
sir.
output, constant sales results in increased profit? No. Profit always increases with sales? Always increases with increase in sales? Need not be. If closing stock is more or less, the profit can change. Profit may decrease with increased sales even if there is no change in selling price or what cost.
Yes, sir. D, sir. Sales அதிகமா இருந்துச்சுன்னா production கம்மி ஆயிரும்ல சார்.
Profit may decrease with increased sales. Simple. When production is greater than sales, when production is greater than sales, then absorption costing will show which profit? More profit. When sales is more than production, when sales is higher than production, though the sales is more than production, what happens? Absorption costing shows lesser profits. I sell more units than the produced units. Compared to last year, this year sales is more. So though the sales is more, profit will decrease. Profit will what? Decrease. No change in selling price or which one? Cost. Simply because your sales is more than production, okay, your profit under absorption costing will be lesser than which costing? Marginal cost. Assuming that there is a constant contribution margin per unit, the change in the period of operating income by using variable costing can be explained by sales minus variable cost. Sales units into contribution margin. Variable costing. Change happens because of sales and variable cost. Expense now, which one will expense?
Period.
Variable administration cost, variable selling cost and variable administrative cost, we will expense it. We will charge it in P&L account, period cost.
SG&A எல்லாமே period cost தான் சார்.
Total variable cost expensed currently by on variable cost on list. Go through the question further. Okay, they ask you expense to pay.
கீழே வாங்க சார். கொஸ்டின் வந்து அண்டர் வேரியபிள் காஸ்டிங் விச் என்னால் பீரியட் காஸ்ட் தானே சார் கேட்குறான்.
இல்ல how much of expense you charge it in P&L account using variable costing approach கேட்டோம்.
எக்ஸ்பென்ஸ்னா பீரியட் காஸ்ட் தானே சார் வரும்.
இல்ல total variable cost charged against operation. Total variable cost charged against operation.
ஓகே, எல்லா வேரியபிளும் எடுக்க வேண்டியது சார். டைரக்ட் மெட்டீரியல், லேபர், வேரியபிள் மேனுஃபேக்சரிங், வேரியபிள் செல்லிங், வேரியபிள் அட்மினிஸ்ட்ரேட்டிவ்.
12 plus
அது பிளான்டு சார், ஆக்சுவல் சார்.
no, actually if you look at we charge the value of the product based on marginal costing. We charge the product based on which one? Marginal costing. And these expenses are directly charged against income. These expenses are directly charged against what? Income. Inventory value is depending upon what is the planned cost. What is the planned cost? 12 plus 9 plus 4. 12 plus 9 plus 4 ever 25.
ஏன் சார் பிளான்டு காஸ்ட்?
Always absorption costing we'll work out the value of inventory based on which one? Planned cost. 12 plus 9 plus 4. 25 into how many units? 1,25,000. Balance would have been included in the inventory or recognized separately. What is the amount? 25 into 1,25,000.
ப்ரொடக்ஷன் எடுக்கணுமா சேல்ஸ்? அது
இதெல்லாம் direct material, direct labor, variable overheads. We charge it in P&L account. This 1,25,000. 1,25,000 into 25 போடுறோம். 31,25,000 plus this actual variable expenses of selling and administration. 43 lakh.
பி சார்.
I repeat. Okay. 1,25,000 into 25 plus energy cost.
1,250,000
plus 2,50,000. Add up. This is the correct answer. A or B? B. 43 lakh 700. Read the next one. Same data.
அப்சார்ப்ஷன்
Fixed cost expensed on absorption costing basis. They ask you total fixed cost expensed.
ஃபிக்ஸ்டு காஸ்ட் அண்ட் ஃபிக்ஸ்டு எஸ்சிஎன் இஸ்
இது பண்ணிருப்பாங்க. Fixed manufacturing overheadsல பண்ணிருப்பாங்க. Think. Production 1,40,000 இருக்கு. Sales is what? Sales is 1,30,000. Actual production is 1,30,000. Actual sales is 1,25,000. Planned production is what? 1,40,000. What is the answer? Think பண்ணுங்க. See, we know on using absorption costing method, fixed overheads are absorbed based on a predetermined rate. What is a predetermined rate? 5 into how much would have been assigned to P&L account? 1,25,000. Balance 5,000 inventory include பண்ணிருக்கீங்க. P&L account எவ்வளவு charge பண்ணிருக்கீங்க? 1,25,000 into 5. 1,25,000 into 5 plus selling and administrative overheads would have been charged in P&L account. So if you work out, we sold 1,25,000 units into what is the fixed overheads? 5 plus what are the other overheads? 9,80,000 plus 4,25,000. This is the variable overheads assigned against cost of goods sold. Remaining will be included in inventory. This is your which expenses? Fixed selling expenses. This is your fixed administrative expense. Total expenses that is charged in P&L account. What is the total? What is the total? 1,25,000 into 5? Okay, then 20 lakh 30,000. Then 149. Same question. Actual manufacturing contribution margin. Actual manufacturing contribution margin. Actual manufacturing contribution margin. What is the selling price? 70 given. They asked you to work out actual variable manufacturing contribution margin கேட்டிருக்காங்க. Yes, please. Direct material 12, direct labor 9, variable overheads 4. What is the total? 25. So 70 minus 25. 70 minus 25 into what is the actual number of units sold? Into what is the actual number of units sold? $56 lakhs, 25,000. 56 lakhs, 25,000. Manufactured at the end of the fiscal year recorded the data as follows: prime cost, variable overheads, fixed overheads, variable selling overheads, fixed selling overheads. They use variable costing. Inventory cost for the fiscal year will include only these two, 9 lakhs.
So suppose absorption இருந்தா இதுல
plus 1 lakh
SG&A தவிர பாக்கி எல்லாம் ஆட் ஆயிரும்.
plus 1 lakh system.
Okay.
Include up to this
1,60,000.
10 lakh 60,000. Full costing may include fixed manufacturing overheads also. Next.
Assuming operating income. Very costings.
You can find your sales is less than production. Or you can say production is more than sales. Production is more than sales. So absorption costing profit will be more than marginal costing. Absorption costing profit will be more than marginal costing. So 1800 plus what?
Fixed manufacturing.
Difference. What is the difference? 200 units into the fixed cost per unit.
1.2.
Simple. What is the rate per unit? Fixed manufacturing overhead rate per unit.
1.
1. So it will be 200 into 1.
2000.
1800 plus 200 into 1. Why plus 1200 into 1? Why plus 200 into 1? When production is more than sales, absorption costing profit will be more than marginal costing. So, in marginal costing, the product profit is 1800. Absorption costing, the difference in units into $1 per unit fixed cost. What is the answer? 2000. Last question answer 1800. But work out பண்ணணும் correct.
10 minus 6. 4000 minus 1000. 1800, sir. 4000 minus 2200.
1000 into 10 minus 6 will be 4.
4000 minus 2200
4000
is
is your contribution.
1800.
Minus fixed costs are 1200 and 1 and 1000. Your contribution is 1000 into 4. 4000 minus fixed cost less fixed cost 4000 minus 2200. 4000 minus 2200, it will be how much?
1800.
1000. You understand this 4000? 10
Yes,
minus this 5.5 minus 0.5 will give us what? 4. Fixed cost minus 1800. They ask you to find out contribution margin per bracket kettle.
Sales minus variable.
Four into 1.75. How much? Then 0.15 into 9. Point 0.15 into 9.
1.35, sir.
Then anything else?
That's all.
So 22.5 minus these two.
$14.15, sir. Yes, sir. 14.5 minus
Wait.
1.
There is a variable selling cost given. You have to work out per unit variable selling cost.
1.
No, not 1.
Sorry, 2.2.
This 22.5 lakhs divided by that 1 billion. It will give us
2.25, sir.
2.25. That also we need to reduce.
14.15 minus
They ask you not variable
5.
contribution margin or manufacturing contribution margin. Unit contribution margin, all the variable cost will reduce. 22.5 minus all these things will give us how much?
11.9.
11.9 is the correct answer. Suppose the question like manufacturing contribution margin கொடுத்திருந்தா 14.15 correct.
14.
Manufacturing contribution margin it is 14.5. They ask you to find out unit contribution margin. Same question we have seen. They ask you to find out absorption costing operating income. Try பண்ணுங்க.
Absorption costing what, sir?
Absorption costing operating income.
Okay.
Try பண்ணுங்க. Maybe you have to go through the question in your mobile and try. Wait பண்ணுங்க. Numbers தேவையில்லைங்க. இப்போ decision you have to take. What is the production?
More than sales.
Production is more than sales now. What is inference?
Variable costing will be less
Production
than.
is more than sales now. Absorption costing will show higher income than marginal costing.
Higher than variable costing operating income.
No need to even think out the data. Interpretation only. Right? Your sales is less than production, or you can say production is more than sales. If production is more than sales, absorption costing income will be higher than what? Variable costing. Same question கொடுத்திருக்கோம். Next they ask you difference between operating income on absorption costing basis and which one? Variable costing basis கேட்டிருக்காங்க. That will arise because of which expenses?
Fixed manufacturing overhead.
Fixed overheads. Fixed manufacturing overheads. So try பண்ணுங்க. What is the difference? 5,000 into what is the fixed manufacturing overheads? 5. 5,000 into 5 is how much?
25,000.
Absorption costing, we would have taken this in inventory, but not in marginal costing. So difference will be 5,000 into difference in units. Difference in units. Please remember, opening inventory is same. There is no difference in opening inventory. Only current year production is more than sales. So direct 5,000 into 5, answer is how much? 25,000. They ask you to value actual costing finished goods inventory. Actual ending finished goods inventory on absorption costing basis. Try பண்ணுங்க. What is ending inventory?
5,000.
No.
Oh, beginning work. Okay.
Beginning 35, current year production 130, minus sold 125. Now ending inventory will be how much? 40,000.
40,000.
Ending inventory will be 40,000.
1.2 million, sir.
Think about it.
Option B, sir.
Oh,
Uh, COGS
direct material, direct
12 plus
labor,
9 plus
variable
4 plus
overheads,
5.
fixed and variable overheads. We'll include up to this. What is the total?
30.
30 into ending inventory. Ending
40
inventory is like opening stock plus production minus sold out.
minus 3.
Sold out how much? 1 lakh?
25.
So we have got ending inventory of 40,000 units. Value will be, we'll include only this 12 plus 9 plus 4 plus 5. How much? 40.
30.
Okay, 30.
1.2 million.
12 lakhs. Then 158. Same data. Variable costing based 40,000
1 million.
into 25. Only variable cost. Only variable cost of production. Only variable cost of production. That is material
1 million.
plus labor plus variable overheads. So 40,000 into 25, how much is it? 1 million. Then the company produced 1,000 units and sold 900 units. This is the information of the last year, prior year, completed year. Okay, what will be included in variable for this one?
Selling cost, sir.
So 100 minus 16. So 900 into 40.
So 12.
Variable selling cost also will reduce.
72, sir.
400 into, sorry, 900 into selling price minus variable cost. 900 into
100
selling price
minus
minus all the
70.
variable cost, how much? What is the amount? 36, 50,
72, sir.
72, 100 minus 72, 28. What is the
20.
amount you are getting? Less fixed cost. What are the fixed cost? Less the fixed manufacturing cost. 1,000 into 5 and 3,600 and 1,800. Less for now, what is the answer? 14,800. Less fixed cost. Fixed manufacturing cost, selling cost, and administration cost. Your operating income is how much? 14,800. What is the correct option? 14,800.
Yes, sir.
Beginning inventory is given, production and sales is given. So sales is more than production. Sales is more than production. Absorption costing. They are using which one? Absorption costing, like that they've given. Try பண்ணுங்க.
Yes, sir.
What is your sales or selling price? 750 into 200 less
22,500.
let us see. Less, we'll take both standard variable and fixed cost. Standard variable and what? Fixed cost, because its denominator is 750 units per year. So this absorbed and actuals are same. So 750 into 110. 750 into 110 less your fixed 45,000. 750 into 200 will give us 1,50,000. Then this is 82,000. Please remember how many units we manufactured this year.
700.
Denominator is how much? 750
Seven.
units in the. So there is a connection. Okay, let us see. 750 units into manufacturing
20.
cost. Manufacturing cost. Fixed manufacturing cost. 750 into
20.
20. How much is it?
15,000.
15,000. But actual manufactured is
700.
700 into 15. This is what is absorbed. How much is absorbed? 14,000 is absorbed. Balance under absorbed. We'll charge it in P&L account.
So 700 into 20.
Under absorbed. What is under absorbed? 1,000 that we recognize in P&L account. We call it as volume variance or whatever. You can charge it in P&L account. Less under absorbed overheads. Unabsorbed overheads how much?
21,500.
Answer is how much? Net income. How much you get?
21,500.
I repeat. This is your cost. This is your selling cost. This fixed overheads are absorbed based on what? 750 units. But actual production is only how much? 700 units. That 50 into 20. 50 into 20 would have been what? Under absorbed. That is adjusted with which one? Net income. So net income is how much? 21,000. Fine. Net income is 21,500. Next. Simple question only, you can answer. Directly one line answer.
5
Only
lakhs.
this can be included.
So 50 lakhs.
Variable manufacturing cost is 5 million. That is the cost of inventory. That is the cost of which one? Inventory. Done. Same data, same data, same data. Using which costing approach? Variable costing approach. Using variable costing approach. What is the sales?
200. Sorry, 750.
750 into 110 போடுங்க. 750 into selling price minus variable cost.
82,500. So
That is your contribution. Minus fixed cost. What are the fixed cost?
20 into 750.
20 into
750. 15,000.
then your selling and administration overheads 45,000. Reduce these two.
22,500. So
Net income 22,000.
500.
Net income 22,000. Answer is C. 163 part. A company is setting up a new division to sell the products in Africa. An accountant has determined new African division will have what? To sell 2,50,000 units. What is the contribution per margin in which division? African division they ask for. Okay. Simple. Sales minus variable cost will cover up which one? Fixed cost. That will be equal to fixed cost. The contribution will be able to cover which one? Fixed cost. What is the fixed cost? 3,65,000. Okay. What is given? Total sales, how much is given?
15,000 இருந்தா இவ்வளோ cover ஆகும்.
Yes. So what will be your variable cost? What will be your variable cost? Balance. 1,15,000, 1,10,000. So per unit cost will be 1,10,000 divided by 2 lakh. Sales minus variable cost should be able to cover up your contribution that is equal to fixed cost. So what should be your variable cost? 1,10,000. They ask you contribution margin per unit. இதுக்கு இவ்வளவு ஒர்க் பண்ணிட்டு contribution should cover up fixed cost. ரொம்ப சிம்பிள். Fixed cost is equal to contribution. So contribution margin will be 3,65,000 divided by 2 lakh. They don't ask you variable cost. They ask you which one? Contribution margin per unit. Direct target. We want to cover up 3,65,000 contribution. That is fixed cost. So 3,65,000 by 2,65,000. What is the answer?
1.46.
1.46. Either variable cost difference between which one? Total sales and fixed cost will be variable cost divided by number of units. They want to just cover the fixed cost. In order to cover the fixed cost, what should be the contribution per unit? Which means sales minus variable cost should be equal to contribution. That is equal to what? Fixed cost. It's more like a break-even point. Money they ask. 164. We sold how many units? Difference between absorption and marginal costing கொடுத்திருக்காங்க.
375 by 0.35.
Extra
Sorry,
375 இருக்கு.
divided by 3.5.
Divided by 3.5. Divided by 1 point. Fixed manufacturing units.
Sorry.
Fixed manufacturing units. How many units?
$250.
So when your absorption costing profit will be more, when production is more than sales. When production is more than sales. So sales is given to us. What is the sales given to us? 1,000 units. How many units they should have produced? Production would have been more than the sales. So what is the answer? 1,250 units.
1,250.
Production should have been 1,250 and sales is 1,000. Difference was 250. Okay? So the production should have been how much? 1,250 units. Next. Thousand units and sold 900 units. 130, etc. is given. Operating income using absorption costing paper. Operating income using which one? Absorption costing. All these costs are inventoryable cost. 100 minus 65? 35. 35. Into how many units sold? 900 units sold. 900 minus 35 minus variable selling cost minus 900 into 12. 900 into 12 less 3,600 less 1,800. You understand how do we get this 35? How do we get this 35? 100 minus all your variable and fixed manufacturing costs. So do this. 900 into 35 minus 900 into 12 minus 3,600 minus 1,800. What is the answer?
15,300.
Much?
15,300.
15,300. So we include fixed manufacturing cost also in which one? Inventory cost. Variable cost is 30. Fixed cost is 6 lakhs. Selling cost is 4 lakhs. We sold 1,20,000 of a product at a selling price of how much? 40 கொடுத்திருக்காங்க. So we manufactured 2 lakh units. We manufactured how much? 2 lakh units. What is the fixed manufacturing cost per unit? 6 lakhs divided by 2 lakhs. 3 per unit. So while working out operating income under absorption costing, 1,20,000 units are sold into 40 minus variable cost 30, fixed cost 3. Okay, and this will give us the surplus. You understand how the 30 variable cost? How the 3? 6 lakhs divided by 2 lakhs. So this minus what? Selling overheads 4 lakhs. Do this. $8,40,000 minus the administrative cost. 4 lakhs will give us 4,40,000. 4,40,000. 2 lakh units, 36 lakhs, same under variable costing. So under variable costing, the same calculations.
3 மட்டும்.
The 3 இருக்காது. Less manufacturing cost also. What is the manufacturing cost? Fixed manufacturing cost? 6 lakhs.
6 lakhs.
What is the answer? 2 lakhs. 1,20,000 into selling price minus variable cost. Both fixed manufacturing cost and administrative cost are treated as what? Product cost. 168 per. $50,000 sold 45,000. What is the fixed manufacturing cost per unit? 50,000 divided by, that is 2,50,000 divided by 50,000. Now, what is the cost? 5. What is the difference in units?
25,000 higher. Option A.
25,000. 5,000 units are different into 5. Simple. Production is more than sales. When production is more than sales, absorption costing profit will be higher than marginal costing. Absorption costing will be 25,000 higher. We consider only the fixed cost per unit. Why? The profit between absorption costing and marginal costing differs only because of which fixed manufacturing overheads. Inventory 6,000 units manufactured, 5,000 units sold. So what is the difference? 800 into fixed manufacturing cost. 800 into 3. 800 into 3. Absorption costing income will be 800 into 3. How much? 2,400 again. 8,000 into 3, 2,400 again. Be careful, be careful, be careful. It's not production. It is opening stock. This is closing stock. This is not production and sales. This is opening stock and closing stock. Opening stock is more than closing stock. Opening stock is more than closing stock. Sales would have been more than production. Sales would have been more than production. When sales is more than production, or when production is less than sales, or you can say closing stock is less than opening stock, absorption costing profit will be what? Less than marginal costing profit. So let us be careful. It will be 2,400 lower. Any doubt in it? Suppose if there was any opening stock valued at different rate, there could have been what? Difference in stock. Otherwise, no such difference. They have given stock. Your closing stock is less than opening stock. Sales is more than production. So your absorption costing profit will be lower. Using absorption. Using absorption. At the beginning of the year, inventory is nil. Okay. 40,000 units manufactured. Units sold is how much? 30,000. What is the cost? 6 plus 3 plus 2?
11.
Absorption costing. 6 plus 3 plus 2? 11.
11.
What is the selling price?
30.
30 minus 11.
19.
So it will be like absorption costing.
Fixed manufacturing.
This also you should consider. 1,60,000 divided by 40 also you should consider. 1,60,000 divided by 40,000. 4. This also you should consider. So 30 minus 11 minus 4. 30 minus 11 minus 4. How much it is?
15.
How much is it? 30,000 into 30 minus 11 minus 4. How much is it?
440, sir. 450, sir.
Less Variable selling overheads. Variable selling overheads would be 30,000 into 30,000 into 1 less fixed selling overheads. 1 lakh, so 75,000. 75,000. Reduce this, you'll get operating income. 3 lakh,
345.
option A. Any doubt in it?
No, sir.
Yeah? Okay. They asked you to work out which one? Contribution margin. Contribution margin output பண்ண direct material, direct labor, other variable overheads, variable selling cost also will reduce from selling price. From selling price, reduce this. How much you get?
72, 28 into 30.
28 into how many units are sold? How many units are sold? 900 units are sold. How much you get?
25, 200, sir.
25 200. 25 200 we get. This B. Direct material, direct labor, variable overheads, fixed overheads, variable cost. We use variable costing, so we'll take what? 4 lakh 50,000. 4 lakh 50,000. Full costing, we include what? Fixed overheads also. 4 lakh 50 plus 18, 5 lakh 30,000. Variable manufacturing, marketing, fixed manufacturing, fixed marketing. 1,000 units were manufactured. 1,000 remains as ending inventory. 1,000 units were there in the at the month end. Using method, they ask you to find out full costing, absorption costing method. They ask you to find out inventory value. $710,000. 17. Next. So work out, they have given you operating income under which costing? Absorption costing, how much is given? 4 lakhs. So can you work out fixed cost per unit? 18 lakh divided by 15,000. Fixed cost per unit. 1 lakh, 18 lakhs divided by 15. What is the fixed cost per unit? 120. Clear? So 120 into what is the inventory change difference in inventory? 3,000. 120 into 3,000. 3,60,000. What is the answer? If it is 4 lakhs, the income would have been lower by how much? 3,60,000. The answer is how much? 40,000. Otherwise, production is more than sales. If production is more than sales, absorption costing will have a higher profit. What is absorption costing profit? 4 lakhs. Marginal costing will have a lower profit. So 4 lakhs minus 3 lakhs 60. What is the answer? 40%. Units produced, units sold is given. First, production is more equal to sales, no difference in profit. Second year, again equal. Third year, be equal. The company uses absorption costing system.
Equal. சார் அப்படி பார்த்தா 2-3 ஆன்சர் இருக்கு சார். Equal to year 1 also.
Equal to year. The same activity is maintained in what? Year 3 also. Because the cost would have been assigned based on what? Planned activity. So whatever is the profit or loss in year 1 will be equal to what? Year 3. It will not be like year 2, it will be showing more profit. It will be showing what? More profit. It cannot be greater than year 2. Why? We sold less units, so profit cannot be more than that. It cannot be greater than year 1. Why? Same units are sold. It cannot be equal to year 2 because in year 2 we sold more units. So it will be equal to what? Year 1. We produced 2,75,000, sold 2,50,000. The following costs incurred: material, labor, manufacturing, and selling is given. Difference between operating income calculated in absorption costing and variable costing basis. Simple. Work out fixed cost per unit. What is the fixed cost? Fixed manufacturing overheads per unit work out per unit. What is fixed manufacturing overheads per unit? 22 lakhs divided by 8,75,000. 8. What is the
200.
inventory difference? 25,000 inventory difference into 8. 25,000 into 8, how much?
200.
2 lakhs. 2 lakhs. Production is more than sales. Production is more than sales. So we can say absorption costing profit will be more than marginal costing. Absorption costing profit will be more than marginal costing. Direct your answer.
Option C.
So with this, what is over? Variable costing versus absorption costing.
Costing.